And the capital markets are wide open from an issuance perspective. We're a little bit over $11 billion year to date. And we recently increased our forecast for the year for issuance from the low 20s to the high 20s because we think we'll see even more capital markets activity this year.
Joining me today is Mark Streeter, Managing Director with JP Morgan. Mark, thanks so much for joining us.
Thanks, Matt. Happy to be here.
Now, you were on a panel here at REITwise looking at the state of the real estate capital markets. How would you describe the overall health of the markets as compared to recent years?
Well, certainly the capital markets are open for REITs. That's the good news, right? Don't fight the Fed has been a message of us for the last couple of years here. And certainly while the Fed was tightening, REIT credit was lagging the market. But really since the December pivot with the Fed, when they came out and basically indicated that they'd be cutting rates this year, we've seen REIT credit outperform. That started in December. And when everyone came back in January from the holidays, it really accelerated in January, February, and into March right now. We're still seeing REIT credit outperform. And the capital markets are wide open from an issuance perspective. We're a little bit over $11 billion year to date. And we recently increased our forecast for the year for issuance from the low 20s to the high 20s because we think we'll see even more capital markets activity this year.
How have listed REITs responded to the increased interest rate environment?
So what we've seen REITs do, going back even before the Fed pivoted, right? REITs took advantage of the low interest rate environment and going back, coming out of COVID, so in 21 and 22, they very proactively addressed the debt maturity walls that were scheduled to hit in 23, 24, 25. So they were proactive. They knocked down those walls. They took risk off the table so that when we got to the higher interest rate environment, most of the REITs, especially most of the REITs outside of the office space, they certainly did not have a gun to their head to issue. So they've been very proactive. Now they're a little bit more in a wait and see mode. All right, they're debating how much can we gain in spread, and spreads right now in the investment grade market are at the 5th percentile, meaning only 5% of the time have we ever been tighter. Right? And now, of course, so what you may lose in spread as spreads could widen back out, you may gain in treasury rate, right, as the Fed pivots and tightens. That's the debate right now amongst the Treasury and CFO teams.
And finally, we've seen a number of media stories discussing the potential issues arising from the large amount of CMBS maturing over the next couple of years. What's your perspective of this situation?
So I think while the Fed was tightening, it was tough for my investors on the REIT credit side to ignore what was going on in CMBS. It's kind of like there's a train wreck over here. Don't worry about it. Focus over here. That's a tough argument to make, right? And that's one of the reasons why we were more cautious on REIT credit performance during that period where CMBS was very dislocated. But as much as REITs have done well since December, CMBS has done even better. That market is healing faster, but from a point of more weakness. The patient was a lot more sick when it comes to CMBS than we were in the REIT market. So we're seeing signs of recovery in the CMBS market. We're seeing signs of healing. Of course, obviously, 6, 7, 8%, depending on how you slice it, of loans are in special servicing right now or in some level of sort of watch right within the CMBS market. And so, the problems aren't going away there. Most of the situations are being solved by a kick the can down the road and so forth, rather than a foreclose, right, on those assets. But, we are seeing signs that, given the strength in the underlying economy and so forth, that the kick the can down the road strategy, may be the main path by which, we continue to heal in the CMBS market.